and we look forward to having a robust morning. Today, we're going to be talking about not just employee retention tax credits, but also a little bit about AB5, which has to do with independent contractors. So get ready, and we'll have a very robust, exciting morning. Once again, thank you for joining us. Human Capital Management is the production company that puts this together, which is a firm that I established in 2019. And what Human Capital Management does is it provides solutions for businesses, everything from education, training, what we're doing now, loss control, management, and risk management. So these are things that we specialize in, and look forward to helping you or any of your associates in these realms. We're sponsored, and we've partnered with Southern California Corporate Growth Partners. We're excited to have them, and thank them for participating. What they do is they have a diverse array of services, but really, in a nutshell, what SoCal Corporate Growth Partners does is help businesses, and they have a variety of services, everything from education, finances, through civic involvement. So they're just a great asset to our community, and we thank them. Again, they sponsor this event, so we thank them for their participation. If you need any information, just their website there, or you can contact me. Love to make that introduction. So it's interesting times. In 1965, the #1 song in the nation was "Turn, Turn, Turn" by the Byrds. So that kind of gives you a little bit of idea of my age. And some people are thinking, like, what does that mean? But it's interesting that that song was written in 1959, and it really talked about the changes, and it came from King Solomon. It says, "To everything there's a season, and there is a time and purpose under heaven." So what he was talking about is change, and that everything changes. And the song, if you ever listen to it, talks about the paradigms between life and death, peace and war, wealth and poverty, gaining and losing. And really, there are 14 experiences everybody has. And maybe they're saying, Javier, why are you even mentioning that? Because this is the time we're in. I believe we're in a cycle. And as we see these cycles change, think about what would have happened in 2022 if somebody in California, especially Southern California, said, we have too much, we don't have enough rain. That was a consensus of drought. And now we have too much rain. So in less than even 9 months, things have dramatically changed in California. The last I heard, we're almost 9 inches above normal in the rainfall, above. And the rainfall year is from February to February. So it's pretty interesting to see how these things are changing rapidly. And of course, within the last 5 days, the second and third largest banks have been shut down. I didn't even want to go into Google Finance this morning to find out but I know stocks are down because I see something on my phone. So there's changing times. We don't have answers to everything, but I think one of the things that we do here with us here is that we try to keep you up to date with some of those things that are changing. So that's the purpose of these webinars. Our next webinar is the Quiet Quit, April 20th, 10 a.m. Fascinating subject, the Quiet Quit. This has been going on for probably the last 12 months, and it's talked about a lot in the HR circles. I'm going to see if we have Carmen Torres and introduce her. I'm going to look through here, and if I see she's logged on, she'll give a quick hello. I don't see her on the list yet. So Carmen just does a great job And really, she's going to be talking about the quiet quit and what that's about, and how firms can address that and realize that. I think I do have Carmen. So good timing, Carmen. Good morning. Just talking about you right now, mentioning that you're going to be hosting, you're going to be presenting next month, the quiet quitting. Good morning.
Hi, good morning. Yes, thank you so much, Javier.
Can you tell the audience what is the quiet quitting, or the as you have it, quiet
Sure,
quitting? What is that?
sure. Absolutely. Quiet quitting is not what it sounds like, your employees quietly exiting or quitting on you. What quiet quitting refers to is actually employees who are doing the absolute minimum in their job. And that's what it means. It means they're no longer going above and beyond. They are just focusing on their job description duties is really what it means. So I think, one of the things that we're going to really be focusing on is how can you support your team members during this time? How can you recognize that this is happening? And what are the impacts that it has, in your place of work? Some of the things that can happen is that there's, more absenteeism, morale is low. So what we're going to talk about is that how do we improve that? How do we reduce absenteeism? How do we improve morale and loyalty? How do we get your team to reconnect, to feel like they're making a difference in their place of employment? And I think that this is definitely a topic that all of you should join us for. And I look forward to having that conversation with you, asking, or I want you to, be in the position to ask questions. And I look forward to answering all of those questions around quiet quitting.
Great. Thank you, Carmen. And if somebody wants to chat with Carmen, I've just on her screen, there's your information. You can email her or contact her. And I think she'd be more than happy to talk with you about that and other issues. But yeah, that's when I first heard that, it really stunned me. Throughout my career, I realized nobody had put a label, but I had a couple people that were under that. I could say were categorized as they had already quit and they're still receiving a paycheck. Well, hopefully, again, this is just something that, again, with good management skills, the ever-changing workforce, Carmen can guide us through that. So, Carmen, thank you again for
Thank you.
for leading us through that. We look forward to next month. So
Thank you, Javier. I
excited
look
to have
forward
you.
to it.
Yes, thank you. Gracias.
Thank
So
you.
we're gonna move on. All of this will be all this content. Last month we had our labor webinar. It was excellent. Go into our YouTube channel and you can get every webinar that we've had. Especially we had a lot of questions and a lot of people wanted. Juan Torres did an amazing job and wanted more information, but it's there. It's on our YouTube channel. This segment will be on our YouTube channel in a couple days. So you can just keep on tune. Every month we'll update you with what's happening there. So we're gonna move on. So today's agenda, we're gonna make it short, sweet, but we're gonna make it very effective. We're gonna talk about employment status, number one, and AB5. And we're gonna have a featured speaker. He's gonna give a very short clip of that. So it's not gonna be very long, but I thought it's just such an important item. We were very fortunate to have Richard Concepcion, who I'll introduce shortly, to talk about that, and he's got a great expertise in that. There may be some questions, so we'll have that. Any questions you have, please put it on the chat. And then, of course, our main topic today, Jerry Packard's going to talk a little bit he's going to talk about employee retention tax credit. So we're excited to have Jerry. So let's start. Let's get this rolling. And I want to introduce Provident Tax Consulting. Richard Concepcion is going to talk about AB5. Richard has over 19 years experience with the EED. He says now he's on the, I guess he calls it, I left the dark side. He says he's now on he found the light, and now he represents businesses with that. So, Richard, thank you again for joining us today and sharing a little bit about, this employment status. I know throughout my career, there's always been a lot of questions about, what does that really mean? And AB5 also either has brought some light and some more confusion to this issue. So with that, Richard, thank you.
All right, good morning, everyone, and thank you, Javier, for the introduction. Yeah, let's face it, if you have a business and you want your business to grow, you're going to need help. And if you need help, you're going to have to hire workers. Now, within this area of workers, you're either going to have an employee or you're going to have an independent contractor, and that's pretty much it. Now, before AB5, we're talking 2019, and before that, we had this idea of common law. And if you can go to the next slide, Javier. And by the way, I was a tax auditor with the EDD. Before that, I was a tax collector with the EDD and a tax consultant. And even before that, I was with the unemployment insurance branch of EDD. I quit last year and I decided to start a business. And now I got the designation of enrolled agent. So I'm able to represent people not only with EDD audits, but also with IRS audits as well. So if you need any help with that, you can come and give us a call. Anyway, so we had this idea pre-1/1/2020. If you were looking at employment, most of your employment situations would fall under this idea of common law employment. And with common law employment, what you're looking at is this primary factor. And that primary factor is the right of direction and control. And this whole idea of employment status, that's what we're trying to determine. Do you have an employee or do you have an independent contractor? So with this primary factor, what we're looking at, the right of direction and control, means do you have the right to direct or control who, when, why, where, how? What is it that the people do? How do they do it? How quickly do they do it? Where do they do it? Do they have to wear a uniform? Do they wear your logo? See, all of these things go towards that primary factor. And since it is a little bit ambiguous and it's somewhat difficult to tell what it is, then we have this idea of the secondary factors. And the secondary factors are more detailed, and they're used to prove the primary factor. That is, the length of time that they've been working, the actual right of direction and control. Can the worker incur a profit or a loss? All of these things go into proving the primary factor. If we go to the next slide, please. So effective 1/1/2020, there was legislation that was passed, Assembly Bill 5, that now we went from the straight common law test now to this thing called the ABC test. And there's something important here. If you look, it says the worker is presumed to be an employee unless the hiring entity demonstrates that all three of the following conditions are met. So I know that if you watch court shows type thing with, civil court or even criminal court, there's that whole thing about you're innocent until proven guilty. Well, with this ABC test, it's backwards. You're actually guilty until you can prove that you're innocent. So that's why this is so important. And with over 1 million employers in the state of California and upwards of 19 million workers that are classified as employees, this issue comes up quite a bit, particularly after the pandemic, where people who were perfectly classified or perfectly happy being classified as an independent contractor before, because of the monies that were made available with the pandemic, all of a sudden they said, you know what, I don't want to be a 1099 anymore. It turns out I'm W-2. And this idea started going into the EDD. So now we have a huge influx of audits that are going to be as a result of the pandemic, and people who were perfectly okay with being 1099 before, now they're not okay with it. So add to that the more stringent standards of the ABC test, and we have something that's become quite interesting. So let's look at the factors real quick. Factor A, the individual is free from control and direction, both under contract and in fact. So there's two things that I want to point out here. Number one is this idea of control and direction. That sounds a whole lot like the primary factor that we talked about under common law employment. And there are various similarities. The second thing I wanted to touch on is both under contract and in fact. So under the ABC test, if you're going to have a contract if you think that you have an independent contractor. It's going to be very important. You have to have that contract. But what this is saying is not only do you have to have the contract with the correct verbiage, but in actuality, when somebody does an interview, the contract, whatever verbiage is on the contract, actually has to be played out in real life. So if the contract says one thing, but reality says something different, then there's going to be a discrepancy that has to be addressed. If we look at prong B here, it says the individual performs work that's outside the usual course of the hiring entity's business. So, for example, let's see, for example, if you have a situation where, let's say that you're an insurance business and you have an insurance clerk, that is kind of the same work. So it's going to be very difficult for that insurance clerk to be listed as an independent contractor. However, let's say that that insurance business hires a plumber to come in and do work at their office. That's going to be very easy to have that as an independent contractor because it's a totally different line of work. And C, the individual has their own independently established business of the same type as the work performed. So the question here is, do these people or does this independent contractor truly have their own business? Do they have a business license? Do they have some sort of a business entity that they set up? Do they do their own marketing? Do they have a location of their own? Do they have business liability insurance? Basically, what we're looking at.
Richard, looks like you have been muted. Let's see if we can correct that.
Yes. Okay. I'm back.
Yeah. Okay. Got you.
Okay. So what we're looking at is that the individual was actually in business for themselves. I know a lot of times what would happen is somebody would say that they're 1099, but when you look at the relationship, they really didn't have their own location. They didn't have their own company identity. They didn't have their own brand. They didn't have their own logo. They didn't really have anything of their own. All they did was they showed up to whoever hired them and they used all of what they had. So were they truly in business for themselves? Well, not necessarily. So these are things that have to be considered when looking at the ABC test. Now, if you go on one more slide, Javier.
All right. Yeah.
There are exceptions to the ABC test, and the following services could be exempt from having to go through that ABC test. And we have specific occupations like doctors, lawyers, psychologists, architects. We also have professional services such as marketing, enrolled agents, freelancers, etc. We have real estate, let's see, and business-to-business contracting, construction. Now, most of the businesses that have someone that you're contracting with, it could be somewhat of a catch-all on number 4. So if we look at that in detail, I can go ahead and let you know more information about that. So that pretty much concludes my portion. If you'd like more information, feel free to reach out. Thank you.
Thank you, Richard. And I know that was a mouthful. That's why I have the screen up. If you have any questions, please reach out to Richard. His contact information is on the screen. Take a snapshot of it. And yeah, very, very important subject. And a lot of people have experienced being on the wrong side or the dark side of being tested, whether you have a true independent contractor or it's an employee, especially California, very difficult. Richard, once again, thank you for kind of navigating us through that gauntlet. We look forward to having you back soon. Now, I want to start with and introduce Jerry Packard. Jerry, I got to meet recently, and our focus today is on employee tax credits. Thank you, Jerry, for joining us this morning.
You're welcome.
appreciate you having there, being part of this. Now, I asked Jerry to come on because a lot of people are moving into this space. Since COVID, we had the PPP loans, we had a lot of help from assistance from the government, and it really kind of developed the cottage industry. But there's been a lot of people that have moved into this industry that really didn't know and understand these credits. And we've seen a lot of, especially my clients, with questions and having people prepare them that just didn't have the background. And Jerry's firm is a specialist in this type of, especially in this space. And that's why I thought let's get an expert to clarify and remove all of this, either the boogeyman or the other side of it, of what is going on with these employee tax credits. So Jerry, once again, thank you for joining us and help navigate us through this this whole idea of who qualifies, who doesn't, and what is employee tax credit for the retention of employees.
Thank you, Javier. I appreciate the opportunity, and thank you everyone for joining. I'm actually going to turn off the camera because I don't want to distract you with my mug, but I wanted you to at least see who is presenting. So turn that off, and we go to the next slide, please. Thank you. As Javier said, Omega Accounting Solutions is an expert in government tax credits. We were founded in 2007. We started off in fractional accounting, doing fractional CEO, fractional controller. We got into business intelligence. We have 9 in-house developers. We then started into government credits in the R&D credit, which is an annual credit, research and development. And so when the CARES Act hit, we were uniquely positioned to handle ERC, or employee retention credits, or you might have heard them as ERTC, employee retention tax credit. We are located in Irvine. We have earned a lot of designations. A couple of the fastest growing private companies. We were listed in the Orange County Business Journal this year as the fastest growing mid-sized company in Orange County. We were actually featured on the Orange County Business Journal front page yesterday. We've also been designated a top workplace by the Orange County Register. Now, ERC is a very, very hot topic. You're probably seeing ads on TV or hearing something on radio, could have been spammed, could have gotten phone calls. And Javier is correct. It has created a cottage industry. And there have been some very good and qualified providers that have jumped into the space. And there have been a lot of bad actors that have jumped into the space. And we'll cover that a little later on. What I'm going to do today is just try to give you a very high level overview of ERC, try to separate the facts and the fiction. And at the end of this will be my contact information. If you have any questions, you are more than welcome to reach out to me, and we'll try to answer every question that you have if we don't have time to answer them through the Q&A through the chat. Next. So a little bit about the CARES Act. The CARES Act was the response that Congress came up with for the COVID-19 pandemic. There were really 2 paths to the CARES Act when it related to stimulus for small business. Now, the government has always done some kind of stimulus. It has typically been targeted towards the large players, if you will. We just saw very, very, very recently, a couple of days ago, the banking industry, and we bailed out the banking industry in the past with TARP and whatnot. We bailed out or given stimulus to the airline industry. We have given stimulus to the automotive industry. Never has there been a program like this that has targeted the small to mid-sized business owner. So there were 2 paths to do this. One was PPP, and the other was ERC. They were mutually exclusive in the beginning, and a business owner could not take advantage of both. Now, in the beginning of 2021, there was an amendment made to the CARES Act that affected ERC, and it affected it in several ways. The first way was it now allowed business owners that had applied and accepted and had been forgiven funds for PPP to now apply and potentially receive ERC. Next. So it is called, well, the employee retention credit is a refundable tax credit against wages paid. They call it a tax credit because in the beginning it was actually a credit against the the federal employer payroll taxes that you as an employer pay. It is now paid to you in the form of a check. So it is no longer actually something that you're going to take advantage of going forward. You're going to actually get a check. The way that we actually claim it is through an amended 941, which is called a 941X. The way that it is calculated is quarter by quarter. So starting in Q1 of 2020 and going all the way through Q3 of 2021. And each quarter is independent of each other. So you can qualify for one quarter, not qualify for another quarter, and then potentially qualify for another quarter. So they're all independent of each other. The program was really designed for employers that have less than 500 full-time W-2 employees. And I want to stress, this is for W-2 employees. If you 1099 all your employees, and it's kind of timely with what Richard was talking about with AB5 and whatnot, but if you are, if you have 1099 employees, they don't get added into the calculation. Now, if you have W-2 and you 1099, no problem. We only count the W-2. There are two tests or two paths for a business to qualify. The first is a reduction in gross receipts or the revenue test, which is probably the most widely known, and we'll get into that. The second one is more than a nominal disruption to business operations, which has absolutely nothing to do with revenue. Again, we'll get into that next. Other changes or amendments that were made in the beginning of 2021 to the ERC program was that it originally started out as a program that was for employers for a maximum of 100 W-2 full-time equivalents. In 2021, they changed that to 500 employees. Second, and really, really significant, was that in 2020, the most a business owner could potentially get per W-2 employee was $5,000 per employee. In 2021, that jumped up to $7,000 per quarter for the first 3 quarters. So essentially, a business owner could potentially receive $21,000 for 2021. So I'm sure on the ads you've seen, oh, your business qualifies for $26,000. Well, it could potentially qualify for $26,000 by adding the $5,000 from 2020 and the $21,000 from 2021 together to make $26,000. I will tell you, it is extremely, extremely rare that a business owner gets $26,000 per W-2 employee. I would be very wary of a provider that tells you that you qualify for $26,000. It's nearly impossible. The stars have got to be just truly aligned. Next. Okay, so the first path to qualify for ERC is a decrease in revenue or decrease in gross receipts. We're always using 2019 as the baseline. So whenever we're comparing either 20 or 21, we're always comparing it to the same quarter in 2019. Let me give you an example. Let's say in Q3 of 2020, you have to show at least a 50% drop in revenue compared to Q3 of 2019 in order to qualify for that quarter. Now, another significant amendments to the ERC program in the beginning of 2021 is that the threshold for the decrease in revenue was substantially lowered from 50% to 20%. So an example, Q1 of 2021 compared to Q1 of 2019, you have to show a 20% decrease in revenue to qualify for that quarter. Same thing for quarter 2 and same thing for quarter 3. So quarter 3 of 21, you're going to compare to quarter 3 of 2019. Now, just as I got done saying, we always use 2019 as the baseline, you have to remember we're dealing with the IRS. So of course there's going to be a caveat there or an asterisk. And what that is, and it's actually to our benefit or to your benefit, there's another method to actually calculate it by moving quarters around, which is called the alternative quarter election rule. So essentially, instead of getting into the weeds, what this means is if you don't really show that you've dropped by 20%, you had a drop, but it's not by 20%, and you've done a back of the envelope calculation, you might still qualify by using the alternative quarter election rule, because we can move quarters around and not necessarily use the same quarter in 2019. So there are some ways that we are allowed by the IRS to stretch it out a little bit, if you will. Next. Now, the second path to qualify has no relation, or it is not tied to revenue whatsoever. So your business could potentially have, let's say your business doubled in gross receipts. You did very well in the pandemic, so you held flat, or you increased your revenue, or you doubled or tripled it. You can still potentially, and I'm always going to say potentially because I don't know your situation, I don't know your circumstances, so I can't just say as a blanket statement you qualify, because we really have to look at it. So this is the formal term from the government is called full or partial suspension of business operations. Now that is misleading in my opinion. Why? Because you did not have to shut down either fully or partially to qualify through this more than nominal impact or more than nominal disruption. What it means is that because of a COVID mandate that was in place, either federal, state, or local, that had an effect on your business, more than a 10% nominal effect, we have to actually quantify that on our end, and I'll get into that a little later on. But what it means is that if a COVID order affected your business and you had to make adjustments, or you had to shut down either fully or partially because of a COVID mandate, that you could potentially qualify regardless of revenue. Next slide, please. Some examples of disruptions are social distancing, limited capacity, sometimes specific supply chain issues due to COVID. So if you couldn't get something that you actually needed that was an important component in what you do, and it actually slowed down or prevented you from doing what you do for your livelihood, could potentially qualify on that. And I say potentially because we've got to be able to show that you couldn't get it anywhere else, not only from your primary supplier, but from another supplier as well. Reduced operating hours, an increase to your average time for critical materials and supplies, increased cleaning and sanitation times and costs, employee retention, recruiting, training, are also significant changes in key metrics or KPIs. So let me give you an example of this. Here in California, all the restaurants were required to shut down indoor dining, but they were allowed to operate either outdoors or they were allowed to do takeout. So let's say a restaurant shuts down its indoor dining because of a COVID mandate. It pivots to takeout and it triples its business. And I actually know of a business here down in South County that this actually happened to. So their business goes up. Now, a lot of people, because they only know the revenue test, would say, well, your business went up, so you don't qualify. That is not true, because their dining room had to shut down, which was their primary way of that they earned their income or their revenue before the pandemic, and they couldn't do it now. They would qualify for ERC. Now, as long as that order was in place. Now, what about when they opened up and you had to go to 50% capacity? Again, that is another reason for them to qualify. So there's a lot of different ways to qualify going through nominal disruption. Next. Now, there are some common misconceptions that we hear continually when we're talking to business owners about ERC. One is our business was up, we don't qualify. I just covered that. They could potentially qualify through nominal disruption, even if their business was up. We receive PPP funds. We don't qualify. Again, not true anymore. I will tell you that we have to do we have to see what you actually were forgiven against wages, and we have to back that out of the equation. So we're not allowed to double dip. So the government doesn't want to pay you ERC funds on top for PPP funds that they already provided you, if in fact you took advantage of PPP. I will state that if you did take advantage of PPP and you took advantage of the second round of PPP, so PPP number 2, and you were forgiven, chances are you will qualify for at least 1 quarter of 2021, if not 2. Another misconception is we were deemed essential. We didn't shut down. We don't qualify. Again, none of these are disqualifiers. And a lot of times I'll talk to business owners and they say, well, we talked to our CPA, we talked to our payroll company, we talked to our PEO, and they told us that we don't qualify. And I always want to dig after that. I always dig, well, why is that? Well, we did okay, so our revenue wasn't down. So most of the time when a business owner is told that they don't qualify, it's because of the revenue test, because they didn't experience a decrease in gross receipts. Again, there is a potential, and I'm going to say a potential path for them to qualify through nominal disruption. Next slide, please. I'm just going to briefly cover this. If you have a business that started after February 15th of 2020, you can still potentially take advantage of ERC. The one caveat is that you had to have had an annualized revenue of less than $1 million. Give you a brief example. So if I started a business December 1 of 2020, I did $50,000 in that month, annualized times 12, that would be $600,000. I fall in under the $1 million gross receipts, so I'd be okay. If I did $100,000, that would be annualized at 1.2 million, so I could not qualify for the startup. Next slide, please. Okay, our process, how do we work? And everybody works differently. Our process is that if you're interested, we're going to have a call. We're going to do a discovery call. It's about a 10 to 15 minute max discovery call, walk you through the program, walk you through our process. And if a business wants to proceed, we then send out a client service agreement. We then ask for a nominal refundable retainer. And when I say nominal, starting at $750. Why are we asking for a refundable or a retainer if it's refundable? Because we want the business owner to have skin in the game. What we have found in the past is if we don't get even a nominal amount up front, the business owner doesn't place any value on it. When we do charge a retainer, we find that the document collection process goes quicker. We're able to get through the process and quicker, and we're able to determine if the business qualifies quicker. And that way, the business owner can then receive their checks from the IRS quicker if, in fact, they do qualify. The reason it is refundable is once we go through the process, if we determine the business does not qualify, the business gets 100% of that retainer back. So there's absolutely no risk. Our compensation is paid on the back end. So when the business actually receives their money from the IRS, if a business has at least 10 W-2 employees, not counting ownership, so if an owner W-2s themselves or any members of their family, they're backed out of the equation. So if they have more than 10 W-2 employees, our fee is 15% of the amount. 10 employees, we get a credit for the business of $100,000. Our fee is 15%, which would be $15,000, assuming you paid us a retainer of $750. When you receive your check from the IRS, you would pay us $14,250. So there's really nothing out of pocket except for that small nominal refundable retainer. If in fact you have less than, or the business has less than 9 employees, anywhere from 5 to 9, we charge 25%. The reason there's an increase in that fee is because we're just trying to cover our costs. We have JDs, attorneys on staff, we have CPAs on staff, we have highly compensated analysts on staff. Our labor costs are extremely high. So the credit for a company with 5 employees is going to be, lower, a lot lower than a business with 25 employees, and it's essentially the same amount of work. So we're just trying to cover our costs. Next. After we do the document collection, let me back up and say, once we receive the refundable retainer, a case manager is assigned to that business, and that is the single point of contact throughout the entire process. We then go through a series of analysis, first the revenue analysis, then we go through a nominal disruption analysis, and we create an impact study. And then at that point, we either file, we advise you if in fact you qualify, and if you qualify, we then file the 941s. If you don't qualify, we then send you back your nominal refundable retainer. Next. What is required? It's actually pretty simple. If you don't keep your own books, either your bookkeeper and also your payroll company, if you have an outside payroll company, can get you a lot of these pieces of information. Essentially, we need P&Ls quarter by quarter for 2019, 2020, and 2021. We need payroll reports for 20 and 21. If you offer healthcare as a benefit, an employee benefit, we're going to need your monthly healthcare statements, because that's going to increase the amount of your credit, because that is counted as wages and it goes into the equation. So it will actually benefit you. If you took PPP 1 and or 2, we're going to need those forgiveness applications, because we need to see how much was forgiven against wages, so we can factor that into the calculation so we don't double dip. Next. Omega basically handles everything from document collection to the calculation to the impact study to the calculations to the filing of the 941s to giving you supporting documentation. Extremely important, and I'll talk about this in a minute, but very, very important. Our timeline from the time that we get all the documents, anywhere from 4 to 8 weeks, depending on the complexity of the case. The IRS is taking anywhere from 6 to 9 months to get the checks out. We also have a division called Omega Funding Solutions, which advances through a bridge loan up to 65% of the credit once we determine if you qualify or not. Next. Now, something that Javier mentioned in the very beginning, and something that I kind of touched on as far as how long we've been around and being an established accounting firm specializing in government credits. On October 19th of last year, October 19th last year, the IRS put out a warning. They also put one out on March 7th, so just this last week. And really what it is a warning to business owners to beware of what they call ERC mills, or promoters. These are businesses that got into the business of ERC in the last 2 years and that's all they do. And that's the only reason they got in business. What we're finding, and the reason I'm able to make this claim, is because of Omega Funding Solutions. We also fund ERC that another provider has done. So if somebody used our competitor and they want to actually potentially get up to 65% of the credit they have coming, we're not going to take somebody's word for it if we're giving them money. So we're going to go through the process. So it's really given us an opportunity to look behind the curtain of what our competitors are doing. And what we're finding is they are qualifying businesses for credits that they don't qualify for, or for quarters they don't qualify for, or we're finding that they overvalue credits. And the IRS is really starting to target in on these providers. I might add, the way that they're able to do that is because the IRS is not approving or denying these for the most part. The large credits, they are, the multi-million-dollar ones. The smaller ones, they're just processing the 941s, but they've given themselves several years to go back and audit. So if a business owner gets $1 million from Joe Schmo ERC provider and thinks that provider is the greatest thing since sliced bread, might be, but that business owner could get a notice in the mail 2 or 3, 4 years down the road from the IRS saying, hey, we'd like to look at your backup documentation. Well, a lot of these ERC mills don't provide documentation. And chances are they're not even going to be in business anymore. So the business owner really has put themselves at risk by doing that. So again, if you're dealing with if you're talking to any other ERC providers, that's great. We're not the only ones out there that do a good job. Ask a couple questions. How long have you been in business? What experience do you have with government credits? And what kind of backup do I get at the end of the process? Next. This is really just, talking, kind of saying exactly what I've said before. We've been in business for a long time. We double check. We have attorneys and CPAs that sign off on our filings that are on staff. We have 175 people under roof here in Irvine. And yes, we work on a percentage. We are going to try to maximize your refund because obviously that is better for you, and we get a bigger percent, and we get a bigger piece of, well, we get the same percentage of it, but obviously our fee is then larger. But we're always doing it in the confines of the law. We don't want to have any issues with the IRS, and we do not want you to have any issues with the IRS. We qualify about 75 to 80% of the businesses that we contract with, meaning 20 to 25% of them get their retainer back because we just don't believe it'll either stand up to audit or they just don't qualify. So if it's really gray, we're just not going to do it. So there might be another provider out there that will do it even after we said we're not going to. And, that's on the business owner and the provider. Next. My information is right there. My email is jerry@omega-accounting.com. If you have any questions, again, feel free to reach out if in fact you haven't put anything in the chat room. I really want to thank you for your attention. I appreciate it. And Javier, turning it back to you.
Jerry, awesome. Bravo. Great presentation. I learned a lot, took some mental notes. We did have an early question early on from one of our guests out of state. So the question is, does this apply just to California or does it apply, is it nationwide? What's the jurisdiction here?
Great question. And thank you for that. It is a federal credit. So all 50 states and actually Puerto Rico as well. If you file a 941, you qualify for this business. Excuse me, for this credit, or you could potentially qualify. Let me state that again. If you file a 941, you can apply for the program. Whether you get it or not, or whether you qualify is another story. But if you have filed 941s, you have W-2 employees, you can in fact apply for it.
Okay. And let me just, for our audience, if you have any questions, please put it on the chat. We'll cover it. There's one more question, but use your chat and we'll try to cover that, your question, if you put it on shortly. Just for the sake of time, we're trying to honor the 1 hour commitment that we have here. Jerry, the other question is, so this, how does this involve? So let's say I do qualify. How does it involve my tax filing for that year, the 2020, 2021, or is this totally separate? Do I have to have an amended return, or is this just a total separate transaction?
Excellent question. And a lot of ERC providers are not disclosing this, and it's actually in our agreement. And what it says is this is a taxable event. This will change the bottom line. If you get a refund for 2020 or 2021, it is going to either be depending on how you post it, it's either going to be a reduction of expense of labor or it's going to be income. Either way, it's going to change the bottom line. So I would check with your tax preparer, but it will be a taxable event.
So it is a taxable event.
It
Great.
will change the bottom line of the business.
Okay. And one other question, again, if anybody wants to put something on the chat box, please do so now. The other question is this: you talked about disruption, and can you give us some examples of maybe somebody that didn't have quite met the threshold for reduction in revenue, but there was enough disruption to qualify? It's somebody that you have already seen that has received those funds. Do you have, give us a story, Jerry?
I'll give you a story. I will tell you about, here's a great story. Amazon DSPs, their business was, the DSP are direct service providers. These are the last mile. These are the people that deliver all those Amazon packages to you. And if you were like me, you were ordering a lot on Amazon during the pandemic. These people's business were booming. Well, they couldn't really hire drivers, but really where the disruption was, Javier, is in training drivers and also in the delivery. Training drivers, how do you train a driver? You put them in with another driver, but because of social distancing, they couldn't do that. So what we have found is a lot of times in construction and things like that, they've also had to space out or limit the number of workers that were on a job site. Manufacturers had to actually reconfigure their manufacturing floor. They might not have been as productive. They might not have done as many widgets per hour as they normally did. What else? Companies that had fleets of trucks that could not get parts to service their trucks. Contractors that couldn't get parts or repair companies that couldn't get parts to repair. Almost any business can potentially qualify. I will say that a company though that just worked in an office that went remote does not qualify. In the eyes of the government, remote working working remotely was not considered nominal disruption. So now let's take an insurance agency, for instance, that everybody went to remote working, couldn't qualify. But let's say an insurance agency that normally attended 20 trade shows a year, and that's where they got a lot of their new business. And even though, let's say, their business revenue was up for one reason or another, they could qualify because of that. There are nonprofits that qualify because they couldn't throw on their galas and they couldn't do other things. Schools that had to change the way that they actually did learning through social distancing, through extreme cleaning, healthcare through elective surgeries being canceled, dentistry, all types of businesses can potentially, again, I'm using that word underline, bold, potentially qualify.
Great. And thank you, Jerry, for I love that slide that, that some people that maybe said, okay, I had a, PPP loan, I don't qualify. So I guess the takeaway here is there's a lot of opportunities. Take Jerry's number down, take a copy of this. We'll have this on our YouTube page, and just consider it. Thank you, Jerry, for just a wonderful, robust presentation. I learned a lot personally, and I'm sure those that participated today also had a good takeaway. It was a great investment in time. And I just want to close. So once again, thank you. Gracias, Jerry.
Thank you.
And I want to just let everybody know, save the date, April 20th, 10 a.m. The Quiet Quit, just a great opportunity to understand how to help your business become more efficient in the workplace and how to deal with these human resource issues that we're facing. So once again, thank you all for joining us. We look forward to next month's webinar. And if you have any questions, you can reach out to us. Most of you know have our contact information, and look us up on our YouTube channel if you want to get more content. So have a wonderful day. Keep out of the rain and many blessings to everyone. Bye for now.